In the spring of 1933, somewhere in America, a family lost their home to the bank roughly every 90 seconds. Not every day, every 90 seconds. 1,000 foreclosures every 24 hours, week after week, month after month. Fathers stacking furniture on front lawns. Sheriffs nailing notices to doors. Entire neighborhoods watching the auction gavels come down. And here's the detail that almost nobody remembers. Most of these families hadn't done anything wrong. They hadn't overborrowed. They hadn't missed a chance to lock in a better deal. They were destroyed by the design of the loan itself, a financial product so fragile, so booby-trapped, that when historians look back at it now, they struggle to explain how an entire country ever accepted it as normal. Because here's the thing. You were never told about the 30-year fixed-rate mortgage sitting underneath the American dream. It is not ancient. It is not natural. It did not evolve gradually out of the free market. Before 1934, it essentially did not exist. The mortgage as you know it, the low down payment, the decades of predictable monthly installments, the loan that quietly pays itself off while you live your life, is a government invention. Engineered in a panic, in the middle of the greatest economic catastrophe in American history, by men who were watching the entire concept of homeownership collapse in real time. So the question is worth asking seriously. Before 1934, how did anyone ever actually buy a house? The answer takes us through savings clubs and church basements, loans with hidden time bombs in the fine print, the largest wave of foreclosures the country has ever seen, and a pair of government agencies that rebuilt the American home from the paperwork up while quietly deciding, street by street and race by race, who would be allowed inside. Let's start where America started, with almost nobody owning a home at all. For most of the 19th century, the United States was not a nation of homeowners in any sense you'd recognize. In the cities, it was a nation of renters and boarders. Working families rented rooms, rented floors, rented entire lives. Banks, to the extent your town even had one, were not in the business of lending ordinary people money to buy houses. A commercial bank of that era made short-term loans to merchants and businesses. Tying up money for decades in a workman's cottage was considered reckless, and in many states it was actually illegal for banks to do so on any serious scale. So if you wanted a house, you had roughly 3 options, and none of them involved walking into a bank. Option 1. You paid cash, which meant saving for a decade or two while prices moved without you. Option 2. You built the house yourself, often in stages. A family might live for years in what was essentially a finished basement or a 2-room shell, adding walls and floors as money allowed. Option 3. You convinced the seller to finance you privately, a handshake deal with a neighbor or a land company, on whatever terms they felt like offering. Farmers had it slightly better. Insurance companies and Eastern investors did lend against farmland. But for the urban worker, the door to ownership was mostly closed. And then, out of church halls and immigrant neighborhoods and factory towns, Americans built their own workaround, the Building and Loan Association. If you've ever seen It's a Wonderful Life, you've seen one. That's what George Bailey runs. The idea was almost beautiful in its simplicity. A few dozen families would pool their savings week by week into a common fund. When the fund grew large enough, members took turns borrowing from it to build or buy a home, then paid the money back with interest, which grew the fund, which financed the next family. It was home ownership as a cooperative project. Your neighbor's deposits built your house, and your repayments built theirs. By the 1920s, thousands of these associations dotted the country, and they were the single largest source of home loans in America. They were also, crucially, the only lenders offering anything close to a modern loan. Some wrote mortgages that actually paid themselves down over 10 or 12 years. But they were small, local, and fragile. And they weren't where most of the money was. Most of the money was in the banks and insurance companies. And the loan those institutions offered, the standard American mortgage of the 1920s, is the part of this story that sounds like fiction. Here is what buying a house looked like at the height of the Roaring '20s, when the economy was booming and credit was supposedly easy. First, the down payment. A typical lender would advance you no more than half the value of the house, and many states literally capped loans at 50% of the property's value by law. So on a $10,000 home, you needed $5,000 in cash up front, at a time when a good annual salary was around $1,500. Second, the term. The loan didn't run 30 years, it ran 3 to 5. Third, and this is the trap, you weren't actually paying the loan off. For those 3 to 5 years, you paid interest only. The principal, the entire borrowed amount, sat there untouched, waiting at the end of the term as one enormous balloon payment. $5,000, due in full, on a single day. Now, obviously, almost nobody had the balloon payment. That was understood. The system ran on an unspoken ritual. When your loan came due, you walked back into the bank and refinanced, rolled the whole debt into a new loan lasting 3 to 5 years, with interest only, paid the fees, and kept going. Families refinanced the same house 4, 5, 6 times over the years, permanently in debt, permanently renting their own mortgage. And if you couldn't scrape together the 50% down, you stacked a second mortgage from a different lender on top of the first at brutal rates and fat commissions, because the second lender knew he'd be last in line if anything went wrong. Let's be honest about what this system actually was. It was a machine that worked perfectly, as long as absolutely nothing went wrong. As long as your income never dipped, your home's value never fell, and, above all, your bank still had money to lend on the exact day your balloon came due. Every homeowner in America was, in effect, betting their house on the health of the banking system every few years, forever. And in October 1929, the banking system started to die. The Depression hit the mortgage market with what economists call a double trigger. Between 1929 and 1933, house prices fell by roughly a third, so the collateral behind every loan was suddenly worth far less than the paperwork said. At the same time, unemployment climbed to 25%, so millions of borrowers couldn't make even their interest payments. But the true killer was the refinancing ritual. Banks were failing by the thousands. More than 1 in 3 American banks went under, and the survivors were hoarding cash. So when a family's balloon payment came due, the bank that had cheerfully rolled the loan over 5 times before now simply said no, pay in full or lose the house. It didn't matter that you'd never missed a payment. It didn't matter that you'd owned the home for 15 years. The loan was due, the money didn't exist, and the sheriff came. In 1926, about 6,000 Americans lost homes to foreclosure. In 1932, the number was roughly 273,000. By early 1933, around a third of the nation's mortgages were in default, with as many again behind on payments. And the foreclosure rate hit that horrifying figure from our opening, 1,000 homes a day. The building and loans were collapsing too. When panicked members demanded their savings back, the money was out in 30-year commitments and couldn't be recalled. The entire architecture of American housing finance, the whole improvised patchwork of balloons and handshakes and neighborhood funds, was disintegrating simultaneously. If you're finding this as fascinating as I did researching it, take 1 second to hit subscribe. Before the Grid is all about the invisible systems holding up your daily life, and what happens next is the moment one of the biggest ones got built. Because in the spring of 1933, the federal government did something it had never done in its entire history. It got into the home mortgage business. On April 13, 1933, President Roosevelt asked Congress for legislation to protect small homeowners from foreclosure, and exactly 2 months later, on June 13th, the Homeowners Loan Corporation was born. The HOLC mechanism was radical. It issued government bonds, handed those bonds to banks in exchange for their defaulted mortgages, and then completely rewrote the loans for the families inside the homes. And the rewrite is the revolution. Instead of a 3-year interest-only loan with a balloon, the HOLC gave borrowers something most of them had never seen: a 15-year, fixed-rate, fully amortized mortgage, a loan where every monthly payment contained both interest and a slice of principal, so that the debt shrank steadily to zero and the balloon simply never existed. Between 1933 and 1936, nearly 2 million desperate homeowners applied, and the HOLC refinanced about 1 million mortgages, roughly 1 in 10 of every owner-occupied non-farm home in the United States. Around 800,000 of those families kept their homes. Then, on June 27, 1934, Congress passed the National Housing Act and created the Federal Housing Administration. And this is the true birthday of your mortgage. The FHA's insight was that the government didn't need to lend money at all. It just needed to insure the loans, to promise banks that if a qualifying borrower defaulted, the government would cover the loss. But to qualify for that insurance, the loan had to be built to federal specifications: long-term, fixed rate, fully amortized, with down payments eventually as low as 10% instead of 50%. Suddenly, a bank's safest possible move was to issue exactly the kind of loan that had been unthinkable 5 years earlier. Terms stretched to 20 years, then 30. Interest rates fell as risk evaporated. In 1938, Washington added Fannie Mae to buy up FHA loans and keep the money circulating. And in 1944, the GI Bill layered veterans' loans on top, with essentially nothing down. The modern mortgage wasn't discovered. It was specified, like a building code, and the numbers show what happened next. In 1940, about 43.6% of American households owned their homes, roughly where the figure had drifted for decades. By 1960, it was 61.9%. Tens of millions of families crossed from renting to owning in a single generation. The suburbs exploded outward, and the house became the foundation of middle-class wealth, the asset that quietly built more family fortunes than the stock market ever did. But here's the uncomfortable truth, and it belongs in this story just as much as the triumph does. When the government designed the modern mortgage, it also decided who got one. The HOLC produced color-coded maps of American cities, grading neighborhoods by lending risk, and the FHA's own underwriting standards went further, steering insured loans away from neighborhoods it deemed hazardous, which in practice overwhelmingly meant black neighborhoods, outlined in red. Redlining wasn't a rogue banker's prejudice. It was written into the machinery of the very program that created mass homeownership. White families rode the new 30-year mortgage into the suburbs and compounded home equity for generations. Black families were largely locked out of the exact same government-backed system, at the exact moment it was minting middle-class wealth, a gap whose consequences are still measurable in family net worth today. The mortgage built the American middle class, and it also drew the borders of it. So step back and look at what this object in your life actually is. The 30-year fixed-rate mortgage feels like gravity, permanent, inevitable, just how houses work. It is none of those things. Most countries don't even have it. In much of the world, rates float or loans reset every few years, a little closer to the old American balloon than anyone likes to admit. The version you know exists only because a specific machine went up in flames in 1933, and the government built a replacement with the fire still burning. A replacement so successful that within one generation, everyone forgot there had ever been anything else. Every month, when that payment leaves your account, you are touching a piece of emergency depression-era engineering, still running nearly a century later. Which raises the question this channel exists to ask: what else in your daily life feels eternal, but is actually just a system somebody built recently in a hurry for reasons everyone has forgotten? If this changed how you see the biggest debt of your life, hit that subscribe button and drop a like. Before the grid digs up the hidden machinery underneath ordinary American life, and the next system we're pulling apart is one you trusted today without even noticing.